Welcome to Morningstar. Last week, global markets fell on fears of contagion after China Evergrande Group's liquidity crisis came to light. Since then, the indebted developer has taken steps to try to control its debt, even as other developers come under scrutiny. What does all this mean for Chinese real estate equity and its debt level? With me today is Cheng Wee Tan. He's a senior equity analyst at Morningstar. He's going to make sense of it for us. Welcome, Cheng Wee.
Hello.
You have been looking at the Chinese real estate sector and the debt level they carry. The market is expecting an orderly debt restructuring led by the state. Do you want to tell us more about it?
Yeah, sure. I guess for the China property sector, there has been under heavy policy headwinds for quite a while, and recently, given the concerns on a major developer named Evergrande, um, I guess the whole market is worried whether there be contagion risk to the rest of the market as well. So I guess firstly from our viewpoint, this has been developing for a while. So we think that the credit event that's impending is not a matter of whether it would happen, but could be likely more of a matter of when. However, from in our view, we do not expect a liver moment because what I see Evergrande is more of a case of an over-leveraged company with assets. So in our view, we think the most probable scenario will be that of an organized restructuring process in which we have already seen signs of authorities intervening in terms of loan extensions and also repayments. And we think that from the government's perspective, social stability would be the key focus from the government's point of view. And we think that would translate to fulfilling the completion of projects to deliver to the millions of home buyers, followed by the suppliers and the staff of the company as well. And we've already seen that in the track record of organized restructuring in previous cases of companies in trouble. So, in terms of contagion-wise, we think the potential risk should be likely to be contained well, and China's central bank will also likely channel liquidity towards target sectors to ensure that any potential spillover of the Evergrande default will be contained. But having said that, we think until the current episode is over, that the sentiment on the sector will still be pretty unstable until the restructuring is resolved.
Right. It seems that the Chinese government has been continuing its very strict control on borrowing levels among developers. So, how challenging is it for these firms to get financing nowadays?
I think, yeah, under the tight liquidity environment, especially headlined by the trade rate lines, there are already a lot of small developers that are facing short-term liquidity stress, highlighted by low cash to short-term debt coverage. And recently we think this trend is also further strained by slow mortgage releases, which is posing challenge to cash collection. And if they are also coupled with credit downgrades and cut off in terms of funding access from the capital markets, and if the contract sales do fall due to buyers' loss of confidence, like the case of Evergrande, then it will be very challenging for this type of property players.
So, on a positive note, what are some of your top picks and how are their debt profiles less risky than the others?
Yeah, we think under the current policy environment and also tight financing within the sector, our preference would be towards SOE names with strong balance sheets, and that include the likes of Kohli and also China Resources Land, in which these names have low leverage compared to peers, and with their financial headroom allows them actually to still pursue growth in a consolidating environment by taking opportunities from the smaller players that are currently in the process of deleveraging and consolidating. And moreover, these two companies are also growing their recurring income from their investment properties, which will also be expected to partly offset the cyclicality of their core development business and will also be supportive of dividend growth.
So, lastly, as you mentioned, the sentiment is still quite dented. What do you see as catalyst that could support investor confidence?
Yeah, I guess like I mentioned earlier, the sentiment is still likely to be weak until the credit episode is over. But once that over, possibly there could be some reprieve in terms of market sentiment. And also, if the physical market does face a slowdown moving forward, then potentially we could also see some easing policies from the government to support the market. But having said that, all in all, we would also like to highlight that the government's over underlying policy focus of reducing the high leverage in the system and also curbing speculation would still not shift.
Cheng Wee, thank you so much for your time. For Morningstar, I'm Caitlin.